Hi there, and welcome to this week's edition of Macro Minutes. I'm Mark Gardner, your head of trading. It's the Friday, the 4th of June. We'll start with the disclosure statement. As per usual, the information is summarised within this webinar does not constitute financial or professional advice. It's general in nature and does not take into account your specific circumstances. It should not be acted upon without your full understanding of your current situation and future goals and objectives. Okay. Stocks in our universe this week, Worley's, Reliance and Centuria Industrial, CIP. Okay, now, Worley's had a really positive Investor Day presentation on the 2nd of June. That presentation revealed its new sustainable strategy was working with 29% of the revenue coming from sustainable sources at greater margins, I think, which is probably the big thing. Company had strengthened liquidity, leverage ratios between 1.5 to 2, and the target gearing ratio below the 25 to 30% target. Worley saw an increase in project win rate versus previous half and remains on track to deliver improved second half 21 results. On the 1st of June, Worley announced they also won two new services contracts with Celanese. It launched a new acetic acid unit in Texas. Worley will provide the EPC, engineering, procurement and construction services. And Shell, development of a new 200 megawatt electrolysis-based hydrogen plant in the Netherlands. This will be the largest commercial green plant in the world, expected to produce 50 to 60 tonnes of green hydrogen per day. Look, it was lingering around that 10.50 mark in Worley's for ages. It's been quite an annoying stock to watch, waiting for these things to be presented to the market. But I think on the day it was up about 5 or 6%, and then yesterday was up about 7 to 8%. So it's above $12 now. It was a trading department recommendation from March, and has been a little bit all over the shop. But I think we're in about 10.50, 10.75 or thereabouts, and we've scaled out of half here, just above $12, and happy to run the other half, and see what these guys can do. Obviously, with those increased margins and increased revenue coming from those sustainable sources. Next up, we've got RWC. It's an investing rec. It was released on the 27th of last month. Price was about $5.17. Target price is $5.95, which is about 15%. Australian-based company engaged in design, manufacture and supply of water flow control and monitoring products for the plumbing and heating industry. It's got good geographical exposure: Asia Pacific, Korea, China, America, the US and Canada, and emerging. And products includes fittings, pipings, thermostat products, other products. So the catalyst for the recommendation were the extension of home builder in Australia by 6 to 18 months. Restriction eases in EMEA would cause EMEA market to emulate surge in demand experienced in the US. Launch products in February: Hold Right in-slab tubing support, Hold Right large diameter sleeve, and Hydroflame fire stopping support. This will penetrate markets and bring some upside to their revenue. They could engage in some M&A. They've got a really strong balance sheet with less than 1 leverage and 40 million cash. Obviously, as long as they spend it correctly. Risk is that the rise in copper prices is causing downward pressure on margins in the second half of 2021. Though management could pass these costs on to consumers. Moving on now to CIP. Also recommended on the same day. It was at a price of $3.55. Price target of about $4.17, 7.5%. It's an industrial REIT, investment in industrial properties with a portfolio stretched across Australia. It's about 32% manufacturing, 27% distribution, 17% data centres, 15% transport logistics, and 6% cold storage. Major tenants include Woolworths, Australia Post, Telstra, DHL, Arnott's and Toll. So catalyst for this recommendation were the strong customer retention rate. Average tenancy agreement expires in about 10 years' time, about 2031. So pretty long-term contracts there. There's no need to renew whilst interest rates are low. The 2021 budget, 1.2 billion investment in to improve Australia's digital economy, will encourage businesses to go online, which is a long-term catalyst as the requirement drives tenancies demands higher. Increasing rental revenue in Sydney and Melbourne's industrial sectors up 2.4% quarter on quarter. Tenancy rates have risen to 98.8% and collection rates at 98%. Risks are the strong housing price implies CIP will need to pay more to acquire new assets, and I guess I get the downside of those long-term contracts is that if these sorts of places are heavily in demand, they might lock themselves into a lower price, but obviously that would just depend on how they've structured the contracts in terms of whether it's CPI or whether it's in terms of comparable facilities in the rental rates there. So stocks to watch out for over the next week. We've got OCA, SB2 and CIM. Oceania Healthcare Limited. This stock will be going ex-dividend on the 7th of June and will pay New Zealand 2 cents per share dividend on the 22nd. OCA has provided premium healthcare services across New Zealand. They reported annual earnings growth of about 8% with underlying EBITDA at 56.2 across a 10-month period and have experienced material tailwinds during the COVID period. Management cited their recent successful oversubscribed capital raising of 100 mil, which will be used to acquire Waterford, a retirement village in New Zealand, as a signal the market's receiving OCA's growth strategy well. Moving on now to SB2, which is Salter Brothers Emerging Companies Limited. Their Salter Brothers Emerging Companies Limited is seeking to raise 20 million through the issue of shares, a listing price of $1 on the 10th of June. It's basically a new listed investment company that will provide investors with access to a portfolio of unlisted and listed companies managed by SB2. Portfolio comprises of about 20 to 35 investee companies that are both here and overseas. The investment will provide access to actively managed portfolio by a team that can leverage the people, resources and relationships of the largest Salter Brothers Group entity and manages approximately $2 billion in assets across property, credit and private equity. As well, we've got another one here, CIMIC Group. CIMIC will be going ex-dividend on the 11th of June. We'll pay about a 60 cent per share dividend on the 5th of July. So CIMIC operates in 20 countries, offering construction, mining, mineral processing and engineering solutions to service infrastructure and property markets. So they recently won a new contract, I think on Wednesday, with its subsidiary UGL set to design, construct and install high voltage transmission lines to connect Queensland's first pumped hydro storage project. UGL, a subsidiary of CIM, are a diversified engineering group, end-to-end solutions, and the contract they won is valued around about 150 million. CIM have also announced its intention to take over Devine Limited, the Australian residential property developer, offering housing projects and in Queensland, Victoria and South Australia. Looking ahead, we've got key Australian data and US data. So tonight at 10:30 p.m, we've got non-farm payrolls, US unemployment. Market's been waiting all week for this. We've been fairly quiet leading into it. Last month's number was fairly disappointing. They were expecting nearly 1 million, and I think they only got around about the 200,000 to 300,000 mark. Since then, we've had employment numbers. There's a weekly feeds in there, basically showing that the labour market's fairly restrictive. It's hard to find staff. A few of the states have state governors have actually suspended the $300 unemployment payment, saying that basically it roughly works out to be about $7 or $8 a week. $7 or $8 an hour, with the low hourly minimum wage over there, not that far from there. It does possibly make sense that people are just taking that subsidy and then and not bothering going back to work at this stage. So we have seen about 5 or 6 states suspend that, mainly Republican states. Look, this number will be hugely important and probably set the tone for nearly the rest of the month, I'd say. That probably, along with CPI, which is out Thursday at 10:30. That's CPI in the US. So that's the overall inflation gauge. It's one of the most widely followed, but realistically, the Fed and most central banks are looking at wage pressure and input cost pressure at the moment, and they'd want to see a string of these numbers consistently higher. I think the Fed usually prefers to look at PCE, which we had out last week, which is slightly higher. We've also got next week ECB's monetary policy statement, which is always followed by a press conference. Basically, they'll, as per usual, they'll announce the general changes, and any use of the word tapering will be probably taken as the market will be highly sensitive to. The ECB of recent time have actually been the ones hosing down the tapering more than any other central bank. So I would not; these guys would be the least likely to come out with a surprise there, saying they're going to taper at QE. So, like Australia, look, Australia, I think we've got the RBA next month going to address the pinning of the 3-year bonds. And just generally with the Fed, I find, from my fixed income days, a good rule of thumb is just to almost count how many board members join the chorus of tapering over time, because there is a tendency for them to release statements and backtrack and just test the market to see whether it's ready for tapering in the months leading up. So the more members of the Fed that start talking tapering, I think currently it's around about 3, up from 2 last month, just from my personal count. Once that starts to increase, I think we might start to see those 10-year yields start to head up, and then we'll all be talking about inflation again. So you probably best to still sort of stay close to those value stocks, and anything in that growth sector. You want to have a fairly high conviction rate before you start investing in that sort of thing, particularly on a long-term basis, due to the inflation really going to sort of hack into those growth stocks with those high PEs. Thanks for attending this week's Macro Minutes, and we will speak again next week. Cheers.